Hello, I'm Kim Warren and I'd like to welcome you to this webinar on the power of living business models. Before I start, just note that you can get the slides to this webinar at the link shown here, sdl.re/May17slides, and the chat questions and answers will be live after the webinar at sdl.re/May17QA. What we're going to cover in this webinar is, first of all, we're going to start with the principles of living business models, and we'll then take a look inside one of these and actually see one of these models working. We'll then step back from this and have a look at the science that makes these models reliable. Now, this webinar is aimed at a managerial audience, and managers are not particularly focused on the science that's going on, but what they are focused on is whether the methods and tools that they use are actually reliable. So this science bit is actually quite important. We'll cover a few real-world examples covering quite a range of different settings, and we'll end by telling you about how you can find out more about this method and how to actually do it. Now, what I hope to persuade you of by the time we get to the end of this webinar is, first of all, that senior leaders and executives really should understand these models and know how to use them to tackle real-world problems. And the second thing I want to persuade you is that because of the importance of these models to those senior leaders and executives, that every analyst, every consultant out there working in the business field should really know how to build these models as well. So I'm going to start by laying out a very high-level, simplified, general structure of how a business system actually works when viewed through the lens of these living business models. And we start with the very simple principle that our operating cash flow comes from revenue minus costs. If you've got a cost of goods, then there'll be a gross profit calculation before you get from revenue to operating cash flow. But then revenue comes from the volume of sales that we sell multiplied by the price that we charge. And price is in a yellow circle there, simply to indicate that this is a decision that we take, a key thing that changes the performance outcomes we're interested in. Now, price doesn't just feature in the calculation of revenue and driving the rate of sales that we're achieving. It also affects whether we win customers or lose customers. Marketing also affects whether we win customers or lose customers. And that's what that box and symbol actually mean. The box is a tank containing customers, and new customers are coming in from the left or going out from the left. That's not the only reason why we win customers, of course. We also have to have a range of products and services that the customers want, and they need to be appealing to those customers. And once again, on the left of that, we've got that little yellow symbol indicating that that product range is added to or reduced by our decisions. That's something we decide to do. And to make all of this possible, we have to employ staff, and we have to have in place the capacity, physical capacity or IT capacity, to make all of this possible. And those items drive costs along with the marketing expenditure that we choose to make. So if all of those things flow from left to right and determine the revenue, costs and operating cash flow, why is it complicated? Well, it's complicated because you've got interdependencies in between all of those things. If you haven't got enough capacity to handle the volume of demand coming from customers, then you won't be able to supply either the physical product that they want or the IT-based products that they want, and customers will be unhappy. You won't achieve the sales, and you might actually lose those customers. If you haven't got enough staff, customers will experience poor service quality, and once again, not only might you lose sales, but you might also lose those customers. So those interdependencies really lie at the heart of why a business system is quite complicated. Now, over on the right-hand side, that operating cash flow goes into our corporate cash reserves, but then gets distributed after we've paid interest to the banks and tax to the inland revenue. It gets distributed to the investors. But there's one other thing that happens before that takes place, and that is management looks at that operating cash flow and those cash reserves, and it says, should we reinvest some of that in developing new products, hiring more staff, adding to the physical capacity of the business? And what we're going to show is that the way that that cash behaves, flowing in and flowing out in the form of cash inflow and cash outflow, is exactly equivalent to how customers are added and lost, how products are added to and removed from our product range, how staff are hired and fired, and how capacity is increased or reduced. We need the same principles that we have always used for understanding how cash is accumulated and depleted to be applied to the customer's product range, staff and capacity. Now, this particular structure is adaptable with modifications to pretty much every enterprise you'll ever find, and every non-profit organisation too. Non-profit organisations, public services, may not be primarily interested in generating increasing cash flow, but in order to deliver the volume of services and the volume of sales, if you like, that they need to do, they too have to have customers who drive the demand for their services. They need to have services they offer. They need to employ staff and capacity. So this is entirely generic. Now, in some cases, you need one or two extra items to capture what's going on in a certain industry. If you're in the oil industry, for example, you'd need a stock of oil reserves in this diagram. If you're manufacturing aircraft, you probably need a stock of the order book for those aircraft. And in many cases, of course, there will be intermediaries as well as the end customers. Coca-Cola sells to stores as well as those stores selling on to the end consumers of the product. But with those extra additions, this is pretty much adaptable to all kinds of enterprises. Now, why do these things actually work? Well, that structure on customers and the customers being won and lost is absolutely key to understanding how a business system works. And all of these items behave exactly in the same way that our accounting friends have dealt with cash and cash flow for centuries. The number of customers we have today is the number we had at the last period in time, plus the number we've won in the meantime, minus the number we've lost. There is no exception to that. Now, that's important because if performance depends on these stocks of customers, staff, products and capacity, and those stocks are added to and lost, then the strategic control we have is over those flow rates. How fast are we winning customers and losing customers? How fast are we hiring and losing staff? At what rate are we launching and dropping products? And at what rate are we adding or reducing the capacity we employ? Now, some of these are more controllable than others. We can simply decide to add capacity. We can simply decide to launch or drop products. We'll have to put some effort in, but basically we'll get what we wanted. We can't simply issue an instruction that says win 100 customers. Those customers have got a mind of their own, of course. So we might aspire to win 100 customers, but may not get them. The same is true to some degree of staff hired and particularly staff lost. Those staff have minds of their own to make their own decisions about whether they're going to join us or leave us. So let's look inside one of these living business models. And this concerns, it's a simple case, a very simple case, deliberately so, to show the principles of how these things actually work. And it concerns a small IT support company that had got into some trouble by trying too hard to grow its business. Now, I'm just going to play a recording of this, which will take you through the story, and then how the CEO, who was on one of my courses, used the model to help him figure out a way of getting out of this problem. To see how important these accumulating stocks are, as well as the interdependence and feedback between them, let's take a look at this very, very simple example of a small IT support company. you can see that the client base of this company has grown over about 12 months, but has then fallen away again. And the growth arose because it sent a business development person out to go and sign up new clients, bringing them in to the left-hand side of that stock of clients, as you can see there. But for the client base to have fallen away, something else must have happened. So let's see what that might have been. I've run this part way through, and you can see the client acquisition rate has been high and is now falling away in more recent months. We're now at about month 16. And what's happened is that the demand coming from those new clients, both in terms of the service hours required to bring those clients on and also to support them once they're in the business, has led to an increase in the total service demand on the business. Now that has caused an increase in the pressure on the staff in the business and led to increasing problems that the clients have experienced, and they'll put up with that for a little while, but we've reached the point now where some of those clients are so dissatisfied that they've actually started to leave, and that loss rate is just about the same as the win rate on the left hand side. Let's carry on just a few steps further. And you can see now that the client loss rate has overtaken the win rate on the left-hand side, and the client base is actually starting to fall. Now, if we go over to the right-hand side, we can see that the revenue is starting to fall and profits are starting to decline as well. Now, you might expect that this problem would actually fix itself, because as you reduce the number of clients, then that would be less work for the staff to cope with. But if we look down to the bottom of the model, we can see that things are not quite that happy. That pressure on the staff is not only causing problems for the clients, but is causing staff to be lost. And we're now losing staff faster than we've been hiring them on the left-hand side. And if the business just carries on like this, we'll end up with a pretty unsatisfactory situation at the end. We're actually making less revenue than we were in the first place, and we're making less profit than we were in the first place as well. The only reason profits aren't even lower still is that we are incurring lower staff costs. So what might the business have done differently to avoid these problems in the first place? What to do, when and how much is absolutely critical here. So let's just change this hiring scheme here. And I've just put in a little formula there that makes the staff hiring rise before we actually start that client growth. If we run this again now without advanced staff hiring, we can see that the problems don't build up. We make less profit in the short term because we're spending that extra money on the additional staff that we've taken on. But we don't lose those clients because of pressure on staff. We don't lose the staff because of the pressure on staff. And our revenue stabilizes at a high continuing level, and our profits, after just a small reduction when we've had rather more staff than we absolutely need to deal with the workload, the profit stabilizes and continues to grow at a slow rate, well above the profit rate that we started with. Now, unfortunately, management does not have the ability to go back in time and make historical decisions that were different than it actually took. Unfortunately, we're already in the middle of this problem, and we did not take that decision earlier on to raise the hiring rate of our staff. So we're already in the situation of having overpressured staff. We've already got problems for our clients, and we've already got signs of those clients leaving us. So what might we do from here? Well, there was a rather radical solution in this particular case. The CEO decided actually to help some of the clients move away and get their support from providers who are better able to cope, but at the same time increase the number of staff as well to be able to reduce that pressure. And this is a quick picture of what happened. We've got that extra spike of clients leaving as we helped an additional 6 clients to find support elsewhere. But that very quickly brought the pressure on staff down and reduced the problem rate. That pressure on staff was also reduced by a temporary increase in the hiring rate. It took a little while to get those extra people on board and able to support the clients, but that reduced the pressure on staff still further. and eliminated the problems that the clients were experiencing. So we end up with just a few more clients than we started with, but the loss rate has disappeared and we've got a stable client base again. We've stabilized the revenue and we've stabilized the profit at just a little higher rate than we started with in the first place. But once again, it's not falling. Now we're in a position to plan for future growth, do the advanced hiring properly, and pace new client acquisitions at such a rate that we will be able to cope, we will be able to grow the client base without triggering excess pressure, without triggering client losses, and without triggering loss of those key staff. And that would deliver sustainable profit growth out beyond the end of this period. Now, I'm getting some questions coming in about this case. So one question I'm being asked is, how do you measure pressure on staff? Well, there's a very simple arithmetical measure of that, and that is the volume of demand that's coming from the clients in terms of the number of hours of work required to do what they want done. And all the services that the company offers, they know how long a particular piece of IT support activity ought to take in terms of staff hours. And because you know the number of staff you've got and how many hours they normally work, you simply divide one by the other, and that gives you the pressure on staff. Another question I'm being asked is, could management here have simply hired more staff at the point where they were in bad trouble and get out of the problems in that way? Well, unfortunately, if you take on a large number of staff on top of a staff group that is already overstressed, all you'll do is increase the stress and make it work, and actually probably make the problem worse. Added to the fact that you can't necessarily find that number of good staff that quickly. The next question I'm being asked is how long did this take? Well, this is an urgent problem, and you can't afford to spend days and weeks poring over computer models to do this. But the first model we built, we actually built it in class in under 2 hours. And we did that by asking the CEO to give us his estimate of the various numbers around this model. He then went away and actually adjusted those numbers and got them right and found out a little bit of information about that service demand and the number of people and their capacity. But this really didn't take very long. This is not a time-consuming activity to do. But of course, when he gets back to the business, he can share this with his team and explain to them how he's going to get out of this problem and why he's got to take the radical actions that he did. So this slide simply summarizes that story of the fix for this particular problem. And you can go to this model and actually run it for yourself. If you go to sdl.re/IT support, you can try different things yourself. Figure out what would happen if you'd done a different hiring solution, or maybe see what would happen if you'd made different decisions from the beginning, including different decisions to grow the client base. Maybe you could figure out a way of growing the client base continually out over that timescale. Now, why do these models just work? Well, they handle some things that go on in the real world in a very explicit, quantified way. I've already explained how all of the stocks in this situation and any situation accumulate and deplete. And you've seen how the interaction between the client win rate and loss rate determined the growth and decline in that IT company's client base. And you've seen how the hiring and turnover of staff led to the accumulation and depletion of the staff numbers in that case. But they do some other things that are unavoidable in the real world. They handle those interdependencies. We can capture how that relationship between client demand and work capacity actually affects the loss rate of clients and the losses of staff. We can capture those interdependencies. That generates feedback, and in good times that feedback can help us accelerate growth. We get that word of mouth thing that we like to get going if we possibly can, and that drives growth. Or we get what's known as balancing feedback that kills growth. That's the first thing that kicked in with that IT support business, when the service quality really hurt our ability to continue growing the client base. But then we've got, in that case, that rather nasty reinforcing feedback of worsening pressure on staff, leading to staff leaving, which just makes the pressure on the remaining staff still worse. So these models capture that feedback. And they capture thresholds. There's thresholds all over the place in the business situations that we operate. Those clients were okay with a moderate rate of problems coming up. We understand that things go wrong from time to time, so clients don't go storming off just because there's been one little problem. But when those problems reach a threshold that they're not happy with, that's when you get the tipping point, and you go from no customer losses to quite fast customer losses quite quickly. Same thing applies with things like price and product functionality. As the price comes down, then it doesn't do very much to sales at all, because the product is still simply too expensive. But then you cross that threshold of affordability, and then sales take off. We'll actually look at a model in a bit that includes that particular threshold. And as product functionality improves, it has to be at some minimal level before customers will want to actually buy that product. So we capture those thresholds. And we handle intangibles. Most of the factors in this IT support case were pretty tangible and directly measurable. There was an additional factor here to do with the morale of the staff, which, as you can well imagine, took a pretty bad hit during that episode. But we can handle intangibles, those state of mind things like reputation and morale, things like quality related intangibles, such as the bugs that we find in software, or the reliability of products that we produce. And there are intangibles to do with data and information as well. We can handle those things. Critically, this is not limited to what's going on within the business. We also handle the external interactions. They didn't arise in this case with the IT company, but there are external interactions that we have to worry about, and we can handle that. And this sets the method aside, by the way, from typical balanced scorecard approaches, from typical business model approaches. You would think from looking at some of those that there aren't any competitors and there isn't any external market, because they simply don't feature in the models at all. Well, in our models they do, when they are significant. What this all means is that these models are in a class of their own. There is nothing out there that does what these models can do. They are rigorous, reliable, and quantified. I'm going to show you how we make sure that that's true in just a minute. There are no exceptions to the principles I summarized in that initial chart. Those mechanisms apply in every case. You can't substitute them with something else. There isn't some other way in which you can look at how the business system is working. That is how it's working. They result in templates. When you build a model for a restaurant, for example, it's pretty much the same structure as the model for any other restaurant, whether it's in Australia or Russia or South Africa or wherever. That means that you can replicate that template. The numbers will be hugely different. A fine dining restaurant will be very, very different in the details of the numbers and what they're doing compared with a McDonald's restaurant. And you'll find different sub-templates, if you like. So a high street restaurant will have slightly different characteristics than a community-based restaurant or a roadside restaurant. But you get these templates, which mean that we can generalize from a structure that we know works because we've done it and we've applied it many times before. Pretty similar, by the way, to the way in which SAP and other enterprise resource planning softwares work. They have templates that apply for manufacturing cases, for professional service firm cases, for transportation cases. And the consultants who use those things take those templates and adapt them to the particular company in which they're trying to deploy those ERP systems. Just the same thing applies here. We handle competition. Competition is simply pitching my system against your system. We didn't have to worry about competition in this IT support case because the problems and issues were entirely of our own making. But we'll see a couple of competition cases in a moment and how they work. So I've explained the basic principles of how these models work. I've demonstrated a working example of this. And I hope I've persuaded you that they are extremely powerful and they are not substitutable by anything else. Problem is, we've been locked in this kind of spreadsheet mindset for decades and decades now. So how do we get to this perspective on a living business model from that spreadsheet mindset? So to explain that, let's put ourselves in the minds of this poor chap, this analyst, who's got to do a sales and profit plan for the launch of a new product. Think of something like a Kindle type device. And poor analyst here has reached for his spreadsheet as usual and just reminded himself that the last spreadsheet he built was extremely tedious. It took a long time, boring to work on, hard work to do. And what was worse is that he made mistakes in that spreadsheet, and management wasn't too pleased with those mistakes. And here is the spreadsheet he built last time. You can go and download this spreadsheet from the link shown here. Over on the left, under the purple columns, we've got the financials for the product. Under the blue headed columns, we've got what's happening to sales from first-time buyers and customers who repurchase to upgrade or replace their product. Under the green area, you've got something on marketing spend and the customers that wins. And we've got the information on consumers and owners over on the right hand side. And you can see that our analyst has put a couple of charts there summarizing what happened to revenue and profit, and a second chart showing the sources of sales from first time buyers and repeat sales. So he goes and digs out this old spreadsheet from the last time he did this, and first of all he's got to figure out how he put this thing together, what are all the relationships in this model, and he's got to figure out where the mistakes came from. And we know that there's research being done on this by all kinds of different bodies. Most corporate spreadsheets have got problems in them and errors in them that are so serious as to make those spreadsheet results actually plain wrong. So figuring out where the mistakes are in this is pretty important, but also pretty difficult. So what might Alan Analyst do instead? Well, here is the living business model that he built instead. And you can see down there, you've got exactly the same chart on what happened to sales and profits. The difference here is that that diagram shows all of the relationships between all of the elements with numbers on. And I'm showing very few time charts on this particular view of the model. Now, that's not really a good idea. We need to see those time charts for the items in this diagram. So let's see how that's done. Well, let's go to this particular section of the model. This shows how current owners multiplied by the repurchase rate give rise to that rising curve, that S-shaped curve for the volume of repeat sales that we're likely to get. I put in a constant repurchase rate here of 5% of owners buying a product again each month. Doesn't have to be constant. A very likely thing we'd do here, for example, would be to release upgrades to the device. And of course, when you release an upgrade, those owners of the first version of the product are very likely to repurchase at a higher rate. So you have a short period of higher repurchase going on before it drops back again to a lower rate. So that's shown as a constant parameter, but it doesn't have to be constant. And down at the bottom you've got total sales, but we're only going to get there if we add the sales that we expect to get from first-time buyers. I haven't completed that calculation just yet. So although this may be unfamiliar, there's nothing mysterious going on here at all. Just think of every item as being like a spreadsheet column with its name in the top cell and all 60 periods values running down the columns below that heading. And think of the arrows here as being like a cell reference. So in the repeat sales calculation, it is linked to the values in the columns for current owners and the repurchase rate. And inside each item is a simple language formula. The formula for repeat sales is current owners multiplied by percent repurchase divided by 100. It's not $1.24 multiplied by $C, $4 divided by 100 or anything mysterious like that. It is a simple language formula. So this analyst's initial model does exactly what the spreadsheet did. The piece in the yellow area at the top there shows how that word of mouth effect works. Current owners who like the product go and tell their friends, or people see other people with the product on the bus or the train, and they say, oh, that looks cool, I think I'll buy one of those. That's how word of mouth is worked out. The green area shows how marketing is driving a win rate as well. Just a side comment, by the way, here. We put arithmetical formulae in these items, but you can also put lookup functions in there. So rather than saying new buyers from marketing is X number per $1,000 that we spend, we could look up the percentage of the remaining customers that we would reach as we raise the marketing expenditure rate. So we can use those lookup functions, which management, by the way, finds very intuitive to do, much more intuitive than looking at a mathematical formula. The blue area on the right there simply adds up those two sources of total sales, and at the bottom we've just got a very simplified version of how to calculate profit there. In practice, of course, there'd be rather more detail in that calculation of operating profit. And notice all across this model, as in the IT support case, we've got red lines and blue lines on the time charts. The red line is real world data. In this case, it is our targets and our expectation for how sales and profits will grow over time. They're simply numbers that we've put in, and they are aspirations in this case. For the IT support case, the first 18 months of the red lines were what had actually happened to the client growth rate and to the number of staff we had and to the pressure on those staff. And the second part of the period was what we feared might happen if things carried on. So what we're trying to do is we're trying to get our blue lines, our calculations, to match those red lines. And you can go and see this model and play with it and see what it does. As I say, it does exactly the same thing as the spreadsheet model that our poor analyst had to work with. But in this case, it is completely transparent. There is nothing invisible here about what's going on. There's also a more developed version of the model at the second link, Tech 2 product there, and that includes this threshold effect of affordability. It includes competition with another competitor who's launching a similar product at the same time, and it includes an experience curve cost reduction mechanism. In this model that you're seeing on the screen here, that unit cost reduction has simply been entered by hand. In the second of the models here, that cost reduction is driven by our accumulating sales rate. So once again, here is accumulation in this model. This flow rate is absolutely critical. The rate at which this business attracts first-time buyers to the product is the key mechanism determining its performance over time, because it drives the growth in the number of owners of the product, which then drives the repeat sales rate. So it's important for both of those reasons. It drives first-time sales, and it leads to the current owners that drive repeat sales. It therefore is our KPI. It is the thing we really have to keep our eye on, and we have to keep our eye on the components that make it up. The new customers from marketing and the additional customers, one from word of mouth. Now, I said at the beginning I was going to look at why analysts should use this. And this may seem like more work, but it's not more work. Doing this, building these living business models, is actually easier, faster, and more reliable than doing what we try to do with those awful spreadsheets. Now, why is that? Well, it's easier, faster, and more reliable because you can see how everything is changing. There's nothing mysterious or hidden going on here. And because everything is joined up, not only can you see how everything is changing, you can see why every change to every item is occurring, driven by changes that are occurring to other items. Errors that you make, whether those errors come from getting the logic wrong or getting the maths wrong, show up instantly. You know, if I'd forgotten to divide the repurchase rate by 100 because it was in percentage terms, I wouldn't have to wait and pore over the numbers to figure out that I'd made that mistake. The picture would show me instantly that I'd made that mistake. So that all means that this seems strange, but you actually have to work pretty hard to make errors in these models. They jump out at you and bite you on the nose. And the last thing that makes these models so easy, fast, and reliable is that a comparison on everything that matters between the calculated charts that the model is working out for you and the real-world charts of data that you've put in, whether that's historical actuals or desired future results. The message here is really very simple. If the calculated lines don't match the real-world lines, it's wrong. Go and figure out where the mistake was that you've made. And because you've got all of the causal pathway mapped out, you can start from the first thing that's going wrong and work back to the thing causing that that's going wrong, work back from there to the next thing that's going wrong and the next thing until you find the root cause of your error. So I've shown you that IT support case, and I've shown you how the model's used for something like a product launch. Let me just extend this now to a couple of other case examples which bring up some other important issues. And this one concerns a very aggressive competitive episode in the pharmaceuticals industry. You can see from the timescale here that this played out over just a few weeks. We'll look at in a moment at a case that played out over rather longer periods, much longer periods. This one is a very short-term episode. It concerns a division of GlaxoSmithKline who had the only approved vaccine for a tropical disease, and the vaccine is used by people who are going on vacation, mostly to exotic places where they may catch this disease. So if nothing else had happened, they would have expected sales to grow to that peak around May-June time. That's around weeks 8 to 10 in this diagram, and then fall away again as the travel season comes to an end. And what happened was that they learned 5 weeks beforehand that a major competitor had won approval for a competing product. They've been at war with this competitor for many years in this particular therapeutical area, and the competitor has a larger sales force, and they've got a very strong reputation of competing hard with lower price. And my friend feared that what was going to happen here is that this competitor would take most of his sales, and this is the most important product in his portfolio. So at risk here is nearly a third of the division's entire cash flow. So what did we do here? Well, again, we built a very simple model very quickly in my office, and the focus of that model was on just right dynamic pricing. Now, what do I mean by that? Well, let's say John's product is priced at $60 and he fully expects the competitor to come in at $45. Well, the right answer to what price to charge is not it should be $42 or $48 or $55. It should start at $42, let's say, and then as events unfold, we can get away with moving the price back up through discounting mechanisms to $48 and maybe push it on to $55 later in the period. So it's not that you have a best price to get the answer here. The best price is constantly changing for the situation that you find yourselves in. Over the following few days, we added a couple of things to the model, again with an hour or two of work at each stage. And those additional items looked at how to attack the credibility of the competitor's product. And also, it turned out that there were some pretty useful ways that we could hurt the morale of that competitor's sales force. And sales force in this industry, as in many others, if they lose the motivation to sell this particular product, they're likely to go off and sell other products where they think they're going to be more successful instead. And the outcome of this was, well, John was always going to lose a significant fraction of his sales in this thing. Keeping hold of all of those sales in the blue line was never going to happen. But he was able to hold down that loss of sales to less than 20%. And you can see on the right-hand side here that he's actually closing the gap on the blue line. What he's doing there is he's winning customers back again from the competitor due to those additional attacks on the product credibility and the morale of their sales force. And I've provided a reduced version of this model that, again, you can go and play with yourself. You have a look at what decisions you might take about pricing over this episode in the model at sdl.re/vaccines1. So another question I'm getting coming in here is, well, do you have to model the whole market? Do you have to model everything that's going on? How do you model external prices? Well, the first thing to say is that our price is entirely endogenous. It is our choice what price to sell. We can charge whatever we like. Whether customers buy from us, whether they stay with us, whether they leave us is up to them, of course. But our price is endogenous. The price out in the external marketplace, in this case, we're looking at what we think the competitor is likely to do with the price given their previous behavior. In situations where you've got more than one competitor, you can extend the same principle. You can estimate competitors' likely pricing behavior from what you know about them, and you can group competitors together as well. So if you've got 3 or 4 competitors who tend to be of a similar scale and behave in a similar kind of way, then you can kind of add those up as one competitive group. And when you've done all that, when you add those competitors up with yourself, what you actually end up with actually is an industry model. But it's often not necessary to go to that degree. You only push the model as far as you need to answer the question that you're trying to deal with. Let's move to a very, very different case indeed, and this concerns the testing, financing and managing of a new venture, and this will bring out some other principles about the use of these models. This is an advisory service for consumers who want home improvement projects done. Now, this is something people don't do very often. You don't often fix your roof or put on a large extension. So this means that householders are not very skilled at specifying the project and finding the right contractor and knowing what the price should be. So what this service does, it attracts homeowners to its website, but then works with them to specify the project in a way that contractors can bid for very clearly. And then the service goes and finds and approves and supervises reputable contractors to actually do the work. So the questions for my friend whose business this is were, well, first of all, would it work at all? If it does work, can it make money? Can it make enough money? Will he be able to raise the finance? And as in the other cases we've looked at, there are difficult interdependencies here to get right. What happens, for example, if we don't have quite enough contractors to respond to the contract bids that are coming from the number of customers? Do those customers all go away? Do the projects actually get started and then go badly wrong or take too long? What exactly happens with those interdependencies? My friend's fear here is that those projects don't come in at the rate that he hoped, that he doesn't get the cash flow from the completed projects that he wanted, so he depletes the small amount of cash he raised from family and friends and angel investors, and basically the initiative dies and all those people he hired have to go and find themselves other jobs. What actually happened is that he modelled the business before he launched it. He figured out how the system should work, whether it was realistic or not, and tested the sensitivities. Here is the first extension that he made, though. After launch, he continually updated the model with real-world outcomes and adjusted the relationships in the model to reflect what was actually happening as his business experience grew over time. And the clever bit was to share it with investors. He went to large institutional investors to raise substantial money to back the further growth of this business, and he exposed the model to them. He said, here is my model with the experiences we've had to date and the assumptions we're making about the future based on that experience. You make the adjustment that you want to make. You test out what difference it makes if I've made a 10% too high assumption about the marketing hit rate on customers, or if I've made a too optimistic assumption about the time it takes to find those contractors. You figure it out for yourself. And the investors satisfied themselves that his business idea was basically sound and provided the money he wanted. He then went to the third stage, which we should all aim to get to, which is that he now uses the model to update with weekly information on everything that's going on in his business. And that informs all the operating decisions right across the business and updates the projections. And all his team see the model, they can understand what it's doing, and they reflect on whether it would be a good idea to do more marketing or less marketing. Should they press ahead and find more of those contractors? Are they likely to be short of staff in 3 months' time, and ought they to go hiring right now so that doesn't happen? And you can see an interview with Rod Brown, my friend and the CEO of this business, at the link shown here, sdl.re open talk. And there are more cases, more explanation of the new venture application of living business models at sdl.re New Ventures 1. So I'll just play a short extract from that interview with Rod right now.
So what did your first model actually do? How did that work?
So the first model of the market is very simple. If we were to spend so much on acquisition of customers, and if we had such a dropout of customers who are interested in us, and a dropout of customers who are not interested in our price or our service, and a dropout and so on and so forth. So simply the potato sorter of
so kind of waterfall of who's left in terms of
what would you have to spend
theoretically
to get how many customers,
right.
And what would those customers be spending, and therefore what's the quantum that comes.
So that's the customer pipeline, and you've got something similar on the tradespeople as well?
Correct, yes. So effectively we're promising to customers that we will get their home improvement work done. For that we need a supply of tradespeople or trades businesses to deliver that. So if we overpromise to customers, then we don't have sufficient supply, then customers are waiting a long time for their job to start, or we don't get them prices. So balance is important.
Right. So the second part of the model was looking at what is the feasible rate at which I can find and qualify tradespeople.
Correct.
And match that against the volume of jobs that have to be done. And presumably some simple financials bolted on the back end.
Very simple financials. And our approach all the way through has been to let's try and understand the broad dynamics of the business and the opportunity, and to work out the detailed financial plan by extracting those numbers and putting them into a traditional accounting spreadsheet. So it has been a living document, if you like, as we've moved through. And also, it's informed our internal measurement lexicon, if you like. So we have phrases which are based around the rates of change to each stock in the model.
So you've been able to take the kind of key performance indicators that the model tells you need, and that's what informs the way that the business talks about itself.
Exactly.
Now, I started with this idea of a basic core common architecture for pretty much any kind of business, but in practice we need to add to these some extensions to this. In many cases we need to worry about the quality of these resources. Knowing about the number of customers isn't enough. We need to know about the size and the purchase frequency of those customers, and maybe the demand for service that they carry with them, because customers are not all the same. Same with staff. Staff vary in their experience, so we might want to track changes to the experience levels of staff as well as the numbers of staff involved. We often have to think about pipelines of resources moving through stages. In Rod's case, for example, the pipeline of those home owners going through from initial inquiry to issuing a tender for the project to actually having projects done. There are clearly pipelines for staff, junior staff, middle level staff and senior staff. I've shown you how we need to and can handle competition for resources in the case of that vaccines episode at GlaxoSmithKline. Turns out there are 3 standard mechanisms for competition. That's a case where we're competing in a mature market for all customers who already exist. The tech product case was competing for the emergence of new customers. So we call that tech product example type 1 competition. The competition for customers in mature markets is type 2 competition. And competition for shared customers, Coca-Cola versus Pepsi, for example, that's type 3 competition. We can handle policy. We can put policy into these models, which is automating the decisions that go on. We can and must handle intangibles in many cases, and we can model the growth and sustaining of capabilities in organisations. A really important thing here is that those models are useful on their own. That vaccines model of competition was useful on its own. We didn't need the model to worry about the supply capacity and the product range and all those kinds of things. It was a useful model on its own. The HR function would find a staff model useful on its own, whether or not the rest of the business is using a model to capture the whole business performance. So let's have a look at another pipeline case, and I've added this one also because it's a very much longer timescale. We're looking at a 15-year time horizon here. This concerns RWE, one of the largest power distributors in Europe, and the company had grown cash flows strongly over the years. They had become more commercialized following the wave of privatizations in the industry in Europe. And you can see that the cash flow has grown, but is now just turning down a little bit there. And the worry here is that the company is seeing a quite substantial increase in the frequency of system failures. Well, that's homes getting their power cut off for a few minutes during a day, or maybe for longer than that. And that is beginning to impact on that cash flow. We're having to spend money dealing with these system failures. And the worry here is that those failures would continue to escalate, and we'd have to spend more and more money running around putting out fires, sometimes almost literally fixing those problems. So in this case, a pretty substantial model was built of the aging assets. Assets go through a pipeline of stages in their life as they age. And there are many different types of assets, and they exist in different towns and cities and regions. So it gets to be quite a complex model, but you don't start there. You start with a single model focused on a single class of assets in a well-documented area of the business. You make sure that the model's right there before you replicate it across the other parts of the business. And the reason this is complicated is because you're making complex decisions about maintaining reliable equipment so it doesn't start failing, reconditioning equipment that's not too bad to put it back into as new condition, or replacing really old and clapped out equipment completely. And balancing those expenditure rates is quite a complicated set of choices. What this allowed the company to do was to optimize what it should be spending the money on, where it should be deploying its people, how many people it should actually be employing in its maintenance and replacement teams. And that allowed it to recover the reliability back to the kinds of levels that it had been at. And it was always going to have to throw money at this problem to some degree, but it was figuring out how much money it had to throw at the problem and where to throw that money. And that allowed them to get back to a more stable cash flow. That blue line of cash flow was never going to be sustainable. They had over-restricted the expenditure on those maintenance and reconditioning activities. So that blue line was never sustainable, but they were able to get back to a pretty good, strong cash flow going out from years 12 to 15 and so on. Once again, there's a sample model you can look at. It looks at one of these asset pipelines, and you can try making these decisions about what to spend on at what time, at what rate, over the life of this asset to see what would happen to the operating cash flow outcomes. It should be pretty clear by now that these models, these living business models, are just fundamentally different from other methods and frameworks. They are built on rock solid theory. That's why they are totally reliable. The reason I can be quite pushy about this and a bit un-English, if you like, about saying how good this stuff is it's not my original idea. This method, system dynamics, came from the late Professor J. Forrester at MIT. So he is very definitely the giant on whose shoulders I'm standing. And the rock-solid theory is engineering control theory. That's what we're doing here. Engineering control theory applied to enterprise systems, whether in the corporate sector or non-profit cases or public services, it's all the same. That theory is rock solid, and I've also shown you how it is entirely consistent with exactly how our finance friends have dealt with cash and cash flow for centuries. I think the ancient Babylonians got that idea of checking things in and checking things out from the stock when they were accounting for what was happening to the grain harvest each year. And the accountants picked that up with how they deal with cash and cash flow many centuries ago. So the good news for accountants here is that you can go off and tell everybody else in your organisation that they really ought to be following the same discipline that you've been following on cash and cash flow. Where we end up here is that an organisation should have a customer flow statement. They should have a staff flow statement in just the same way as they've got a cash flow statement and a balance sheet. It's a bit more complicated for customers and for staff because you've got different kinds of customers, different sizes of customers. It's a bit more complicated for staff because you've got different teams of staff and you've got different levels of staff, but it's still the same underlying principle. So that rock solid theory makes these models utterly reliable. The result is that these models do what the real world does, and for the same reasons. It's quite uncanny to see these models play out what's actually observable in the real world. Now, other modelling approaches can generate outcomes that match the real world. We can even make econometric models do that. But what those other models don't do, because they do not have this solid theoretical foundation, and because they don't track all of the relationships between everything else, they might just do what the real world does. But what they don't do is they don't do it for the same reasons. When we're matching those real world results with the calculated results with the red line and the blue line, we're making sure that the model does what the real world does for the same reasons that the real world generates those outcomes. It's quantified and time-based, so management has the ability to indulge in well-informed opinion testing. You're not kind of trading opinions between somebody in marketing and somebody in sales or somebody in customer service. The data tells you about how the system works. And they're intrinsically joined up. Everyone sees how everything links and connects together. Now, another question that's coming in here is how do we deal with missing information? And of course, you're right. We don't always have all the information. Well, there's two things you don't do. The first thing is you don't leave it out because you haven't got it. There is no such thing in these models as leaving out important parameters. If you leave it out of your model, you are actually giving it a hidden value of 1. So, if we hadn't got pressure on staff in our model, for example, and we'd left it out of the model, we wouldn't have been actually leaving it out. We'd have been in there and it would just have had a value of 1, although we couldn't see it. And the other thing is you don't put it in the model and then pass over it and fail to populate it with data. What you do is you put your best estimate on that variable. Put a big red box around it if you want to and say, watch out, this is just an estimate. But you put those estimates in and you ask other people to validate your estimates. and if necessary, go and find out the data to improve those estimates and prove those estimates are about right. So I hope I've now persuaded you why leaders and executives really should understand these models and be able to use them to design the business, to get backing for business initiatives, to run the business on a continuing basis. It's a single integrated view. It breaks down silos. It cuts political friction between different members of the teams. It is genuinely joined up, and it's really easily communicated. People get this really fast. As soon as you start showing them those time charts of things they already understand, they get what the model diagrams are showing, they get what the interconnections mean, and they understand it and can start working with it. And the last reason they should use these models is because they're continually adaptable. As Rod found in his business, keep putting the updated data in and see what that tells you about the future of the business. Adapt the model if necessary, change the relationships to reflect your best, latest information. And all of that means that every analyst and consultant really should know how to build these models. The spreadsheets that they use are simply not fit for purpose. They cannot do what these models do. In theory, you could simply take all the formulae out of these models and bang them in a spreadsheet, but you couldn't possibly build a model like that in the first place. And even if you did that with the spreadsheet, as we showed with the tech product case, the spreadsheet would be impenetrable. You couldn't figure out what all the connections between all of the columns in the spreadsheet were actually doing. And I hope I've shown you that it is easier, faster, and more reliable to do this than to build those spreadsheet models anyway. So why wouldn't you do it? This encourages collaboration. You're building these models with people. You don't go off into your office and come out 2 days later with this spreadsheet that you discover later on has got errors in it. It encourages collaboration because, frankly, it's quite fun. It's actually enjoyable to watch these models emerge and show you how the real world is behaving. So now you can see the value of these living business models. Do go and check out some things. Go and have a look at our online courses, both self-taught and instructor-led, at sdl.re/courses. Our next running of this in 2017 starts on June the 9th, so go and have a look at those courses. There's a ton of free material on our website, strategydynamics.com. Go and have a look at that. And there's also a lot of videos on different topics and different cases on our YouTube channel. Go look at the LinkedIn group, Strategy Dynamics Network, and there are 1 or 2 Pulse articles on there as well. You can get these slides at the link I've shown here. And my last tip is just do it. Go and try it. There's enough material at those sources there to get you started. So just have a go at it. Get in the water. It's really not as cold as you might fear it is. And by all means, get in touch with us if you need to. So thank you very much for your time and your attention listening to this webinar today. I very much hope that you found it useful. I hope if you're a senior leader or executive that you're persuaded that you should understand these models and learn how to use them. And I hope if you're an analyst or a consultant that you'll go figure out how to actually build these models. You'll enjoy it, so have a go at that as well.